Now that we understand that there's value to having markets for insurance, I want to talk about some of the reasons why insurance markets are difficult to manage or may not exist perfectly. In other words, why we might expect to see market failure in many different types of insurance markets. So in order for insurance markets to function properly, in order for us not to have market failure, we have to have a number of conditions that are met. We have to have uncorrelated risk. All right, what does that mean? It means that if something bad happens to an individual, that is uncorrelated with the risk for other individuals. So for example, if we have a fire at our house, right, that's unlikely to result in a fire in the whole neighborhood, right? So we don't expect to see risk of fire to be correlated among different policyholders. Same is not true for earthquakes, right? If there's an earthquake, then that's going to affect everyone in the community. And so from the insurance company's perspective, it's much more difficult to insure that type of risk because with fire, we have some people paying in and we're paying out to some other people. But with the earthquake, then if an earthquake happens, we have a very large payout that we may not be able to cover with premiums that have been collected. So, so fires are more insurable than earthquakes. That's just our example here. Okay. We also have to have really well-defined risk. In other words, we have to have a clear loss. It has to be possible for us to see who was harmed and who was not harmed. Otherwise, people who were not harmed may ask for a payout. So we have to be able to clearly define who has in fact observed the bad outcome. We have to have a well-defined period of time over which the insurance policy is in effect. And we have to have little uncertainty about the probability of a bad outcome. So there are lots of risks that cannot be insured because these things are unclear. So for example, say there's some risk that is associated with pollution. Say it leads to increased rates of cancer in the community. This is not something that we can insure against. Say the company might like to say, well, we will cover your medical costs if you indeed get insurance that's caused by the pollution that's created by our factory. Well, this is probably not a market that can exist because it's not clear whose cancer was due to the pollution and whose cancer would have happened anyway, right? There's not a clear loss because we can observe who has cancer and who doesn't, but we don't know whose cancer was caused by the pollution. These kind of damages occur over a very, very long period of time, right? So maybe you were exposed to some kind of pollution for a while when you were young, and then you get cancer when you're 65, right? And we don't connect those dots. And then finally, we don't know what those risks are always, right? A lot of times we have some new technology or some new situation in which we don't know if there are risks to a certain type of pollution, and if so, how big those risks are. And of course, we have scientists who work hard to study these things, but big disasters like the BP oil spill or rare events, we're really unsure about the probability because they just don't happen very often. Okay, so all of these things lead to an inability to cover risk with insurance. In addition to two others that we can address in insurance markets, right? These things we can't really fix. But there are a couple other problems that we can take steps to address that because they are due to asymmetric information. So these last two are a little different because there are problems associated with asymmetric information. which is an additional problem to the problem of uncertainty. So uncertainty means that we don't know what's going to happen. No one knows what's going to happen. Asymmetric information is a different information problem where one person knows more than the other person. Okay, and this creates problems in many situations, but it also creates problems in insurance markets. One of the biggest ways that we see these problems play out is in insurance markets. So moral hazard and adverse selection are two problems of asymmetric information that are important to insurance markets. Moral hazard happens after the purchase of insurance, and adverse selection happens prior to the purchase of insurance. So we're going to talk a little bit more about each of these, what they mean, and how they lead to market failure in insurance markets. So moral hazard means that if you purchase insurance, then you're more likely to behave in a way that increases your risk because you know that you are insured. So people who purchase insurance take on more risk than they would otherwise if they didn't have insurance, right? So maybe I know I have health insurance and, you know, I let my kids climb a tree, even though they might fall and break their leg because we have health insurance, it'll be fine, right? I don't want my kids to break their leg, but you get the idea, right? We take on more risky behavior when we feel like if the bad outcome occurs, it's not so bad. So you might say people who have car insurance drive a bit less carefully than people who don't have car insurance. And sometimes it's hard to think of ourselves taking on more risk because none of us like to think that we're taking on risk in general, but imagine how you might behave if you did not have health insurance or you did not have car insurance. You'd be very careful driving or careful to maintain your health because you knew that if you did get sick, it would be very costly, right? Or if you did get into an accident, then it would also be very costly. So moral hazard is this type of behavior where we take on more risk when we have insurance. Well, that's problematic because when we have insurance, the insurance company is paying us if the bad outcome happens. So if having insurance increases the probability of the bad outcome, that will increase premiums for the insurance, right? This will increase premiums and thus the cost of the insurance. Okay, so again, this happens after you have insurance. When you have insurance, this type of behavior emerges. Adverse selection happens actually prior to the purchase of insurance. Adverse selection means that only the people who are riskiest will buy insurance, okay? So adverse selection means that the people with the highest risk will opt into the insurance market, and people with low risk may opt out, which again increases premiums, which leads more people to opt out in the low risk category. Okay, so these are both problems of asymmetrical information. The people who take on the risk, they have some sense of what their risk is, but the insurance company does not. So we want to think about ways to address these problems. So we'll talk about moral hazard here, but we're going to do a more detailed example of adverse selection in the next video. So how can the insurance company correct this problem of asymmetric information in the case of moral hazard? Well, we would like the insurance company to be able to still provide an incentive for people to take on less risk. So one way that they can do that is by gathering some information about the risk that their customers are taking on. So in the car insurance example, right, you have companies now that offer a safe driver discount. So this creates an incentive for insurance policyholders to maintain a lower risk level, not to drive like a maniac, even though if they get into an accident, they're insured. All right, good. In the next video, we'll do an example with asymmetric information, adverse selection, and talk about solutions to that problem.